When you're converting pre-tax assets to Roth, one of the biggest questions you face is exactly how much to convert each year. So that's what we'll cover in the next couple of minutes here. We'll go over a process you can use to evaluate exactly what dollar amount might make sense for your conversions. Picking the right amount is part art and part science, and plus you're predicting the future, so you can't quite get it perfect, but you can make a really educated guess on what's a good amount to convert. Now, in this video, we're assuming that you've already done the analysis and decided that you do want to convert. So that might or might not be the case. Please don't skip that step. But if you know you want to convert, this may be helpful. And we're also assuming you already know how proactive you want to be about your conversions. So maybe you know you want to convert a lot. Maybe you know you just want to convert a little bit and maybe get some benefit out of it, or maybe it's somewhere in between. As we go through this, we will use a super simple example. This is Jane, who's going to decide how much she's going to convert to Roth this year. So we're not going to cover every single thing, but I think you're going to get a good idea of the concepts involved here. The first step is to estimate your income, because any conversions are going to go on top of that income, so we need to know what you're working with so far. Those existing income sources might include any earnings from employment or any social security benefits that are included in your income. Maybe you've got withdrawals from pre-tax retirement accounts. You might have dividends and interest in your taxable investments or in bank accounts, and those interest payments have been going up, by the way. You may have some Roth conversions you've done earlier in the year. There may be capital gains and other items that add to your income. Once you have a decent idea of what your income is, don't forget deductions. So you might just assume the standard deduction. That's what we're going to do for Jane this year, but you may have more complicated things going on. So consider that, because that may create room for a little bit more to convert. One of the most important things people look at is IRMAA. So that is, if you're on Medicare or within 2 years of Medicare, your income can affect how much you pay in premiums for Part B and Part D coverage. So if your income exceeds certain levels, then you may have to pay extra each month. So it's important to be aware of that. In fact, that might be one of the reasons, is to manage those future increases later in life. These conversions can potentially reduce the size of your pre-tax retirement accounts, which reduces the size of your RMDs or your forced income later in life, and that can help you potentially keep costs lower later. So for now, during your conversion years, the question is, what level of IRMAA, if any, is acceptable to you? The answer depends on a variety of factors, and that might be how much you're willing to pay now, how much you expect to pay later, and many other things. Paying IRMAA isn't necessarily a bad thing. So if you do it strategically, it can potentially work out for you. But if there's a way to avoid it, or if you get caught by surprise, that's when people aren't always as happy about it. So you really want to look closely at these levels and project into the future. If it does make sense to pay IRMAA, remember that it might make sense to do it for just a couple of years, or even to blow through 1 or 2 extra levels as you do a conversion this year, so that you can do smaller conversions in future years and possibly avoid those IRMAA surcharges. Or maybe you can just spread things out enough, depending on your situation, so that you don't really need to pay much, if any, in IRMAA surcharges. So in our example with Jane, we're assuming she'll have $80,000 of income, and that includes 85% of her Social Security. So we're just assuming that that will already be in there. Of course, we don't know exactly where her income will actually end up. She also wants to stay below this second IRMAA level of $129,000. And again, we don't know exactly where that level will be until 2 years into the future, but we're using the latest number available. So if we calculate the difference, that leaves $49,000 that she could convert if she wants to go right up to that level. In this case, she has decided to go ahead and break through one of the thresholds. So she is going to pay a little bit of IRMAA through the first threshold. Then when you do that, it can make sense to go almost up to the next threshold, because IRMAA thresholds are cliffs. If you go over by $1, you have to pay the full amount. So it can be advantageous to go ahead and and keep on taking income almost up to the next level, assuming it makes sense with everything else that's going on. Next, let's look at income taxes, because that can be another big piece of your decision to do these conversions. You might be able to substantially reduce your income taxes, possibly even having more of an impact than the IRMAA question. Once again, she started with about $80,000 of income, and then we take away the standard deduction, leaving her around $66,000. That's the 22% tax bracket currently. And if she does some conversions, that would move her into the 24% tax bracket. Given everything else that she has assumed and that we're looking at, that is acceptable to Jane. So far, this looks okay to go with that same amount. That said, this can get a lot more complicated, so you really need to do some mock tax returns or some projections to see what's the impact of these conversions. What will it do to other things on the return, not just the federal income tax bracket, because there could be a lot more going on. For example, if your income gets above certain levels, you might face net investment income tax, and that would be an additional tax on certain types of income, and that can be an unwelcome surprise and an extra cost, especially if you're making big conversions or you have a high income. So you want to look at all of these different pieces, making sure that you're still going to qualify for different deductions or different tax credits or different things on your return. In Jane's case, we don't see any issues, so we might stick with it. Now she's in the 22 and the 24% brackets as she does this, and it's going to be a good idea to pay some estimated taxes so that she doesn't face underpayment penalties later, because the IRS says pay as you go so you don't owe. So just to keep it simple here, we're going to assume 23% and she's going to pay that much in taxes. It's kind of an oversimplified way of doing it, but it gets the concept across here. By the way, I'm Justin Pritchard and I help people plan for retirement and invest for the future. And in the description below, you're going to find some resources. That's some links to the information we're looking at, as well as some general retirement planning information. I think you'll find that very helpful. And friendly reminder, this is just a short video. It's not specific advice for you. It doesn't cover everything. So please get more specific advice or do a lot more homework if you choose to take this on yourself. If you're not yet on Medicare, there are some other health-related things you might want to look at. So if you are getting ACA credits or subsidies for privately purchased health insurance, it's going to be important to look at your income and see how Roth conversions might affect your ability to get those types of subsidies. You sort of have conflicting goals here, because on the one hand, you might want to convert, which results in an increased income for the year. But on the other hand, you might want to keep your income low so that you can keep those health insurance costs low as well. So you need to decide what is more important, then maybe look at trade-offs between different levels of conversions as you make the decision. Once you've looked at various pieces and decided how much to convert, it's worth considering a margin of safety, and that might be a buffer between how much you could convert if you get it perfect and how much you actually want to convert, just in case there are some surprises. So you might get extra income for the year. For example, CDs and bank accounts have been paying out quite a bit more. You might think I don't get much out of that, but you might have several thousand extra dollars of income from a bank account this year. Other surprises can also happen, and these are particularly important if you're facing any of those cliff type thresholds. So the IRMAA thresholds, for example, where if you go over by $1, you pay the whole thing. It's not as big of a deal if we're talking about federal income tax. If you have a few dollars in the next bracket up, it's not necessarily going to ruin the strategy, but you do want to be very careful about those cliff items. In Jane's case, we've gone with $10,000, a nice round number. Could be too big, could be too small for you. It's just to get the concept across here. So that margin of safety is, again, just to protect against surprises, so you can decide how aggressive you want to be. And keep in mind that those IRMAA levels will change. They typically rise with inflation, and you don't know exactly what number will apply when you're making those conversions, because there's a complicated 2-year look back that you have to deal with. So it's sort of an unknown. And again, it's up to you how proactive you want to be. Of course, every year you'll need to reevaluate the Roth conversion strategy. Does it make sense? And then go through a similar process. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.